Welcome back to The Deep Dive. Today we're digging into the recent Q2 fiscal 2025 earnings call for Oxford Industries. That's OXM for those tracking.
Yeah, definitely one to watch if you follow U.S. apparel stocks.
Absolutely. Because, look, management was really navigating some tricky waters this past quarter. You had these unpredictable new tariffs hitting, and then just a pretty tough consumer environment, lots of promotions, people being cautious.
Right, exactly. It was a real stress test, you could say. And honestly, they came through it better than many had feared. Management was adapting really aggressively throughout the quarter.
So what's the main takeaway for listeners then?
I think the essential thing is, yes, the operating environment, still difficult. You see that in the revenue numbers, we'll get into that. But their ability to manage costs, especially mitigating that big tariff shock, that's what delivered the win here.
Okay, let's maybe start with how the market reacted right away. Because that reaction, it kind of tells the whole story, doesn't it?
It really does. Because you look at the headline numbers, and it's a bit of a classic mixed bag.
Right.
But somehow that resulted in, well, almost pure euphoria in the stock price.
Okay, break down that mixed bag. What was the good news?
The good news, the essential beat was on the bottom line. Adjusted earnings per share, non-GAAP, came in at $1.26.
Okay.
And the consensus estimate was hovering around $1.18. So that gave investors a nice, 8 cents of breathing room, better than expected profit.
But there's always a but. The top line wasn't quite as strong.
Correct. Revenue was a slight disappointment. It totaled $403.1 million. The street was hoping for something closer to $406 million, maybe a little more.
Okay, so down year over year too.
Yeah, it represented a 4% decline from the same quarter last year, which was $420 million. So like you said, a revenue miss, but a profit beat.
And the market loved that specific combo.
Loved, let's putting it mildly. The stock reaction was huge, massive, positive move. It was a dramatic relief rally.
How big are we talking?
We're talking 14.6% jump after hours, right after the call. And then the next day, it just kept going. Intraday gains of like 20% to 23%.
Wow.
So yeah, it tells you investors were laser focused on the profit protection and, crucially, the guidance reaffirmation.
We'll definitely get to guidance.
Right. And that completely overshadowed the slightly soft revenue and the fact that, total company comp sales were actually negative 5% for the quarter.
So the fear was worse than the reality, basically.
Exactly. The fear of this tariff-induced disaster just evaporated. Poof. Relief.
That relief rally really underscores how important that tariff mitigation story was. But let's not just skip over the actual cost pressures they did face. Where did it hurt most in Q2?
Yeah, good point. The pain landed pretty much directly on the gross margin line. Adjusted gross margin contracted pretty significantly, 160 basis points year over year.
Okay, 160 basis points. How does that translate?
It settled at 61.7%.
Yeah.
And to give you some context, that contraction, it was primarily driven by a hefty, $9 million headwind just in cost of goods sold.
$9 million just from COGS.
Just from COGS, and almost all of that tied directly back to the immediate impact of those new tariffs flowing through their supply chain.
Wow. A $9 million shock in one quarter, that's substantial. And obviously that pressure flows down the P&L, right? Hits profitability.
It absolutely does. And that's why you saw adjusted operating profit drop quite a bit, down to $28 million.
Which means the margin.
The operating margin for Q2 ended up at 7%, which, sounds okay in isolation maybe, but compare that to the 13.5% margin they posted in the same quarter last year.
Less than half.
Less than half. So yeah, the tariffs were definitely the main villain in the financial story for Q2.
Okay, so this is where we really dig in, right?
Yeah.
How did management fight back? How did they neutralize the worst of that potential damage? Because they flagged a huge potential number earlier, didn't they?
They did. They estimated the total potential incremental tariff exposure for the entire fiscal year 2025 could have been as high as $80 million before any mitigation.
80 million. That would have just crushed the year.
It would have decimated the full year profitability. It would have made their previous guidance completely impossible. That 80 million number was like the ghost haunting the stock price all year long.
So the success of this call and that rally really hinged on them convincing the market they could handle it.
Exactly.
Yeah.
It rested on the fact that management came out and said, look, we believe we can mitigate roughly half of that massive exposure.
Okay, half is still $40 million in mitigation. How? How do you make $40 million in tariff costs just disappear? What were the specific levers they pulled? Because that's not just paperwork.
No, definitely not.
Yeah.
It was a multi-pronged and frankly very costly operational pivot. It takes real effort and investment.
Like what?
Okay, first, They did extensive supply chain shifts, moving production out of the highest tariff regions where they could. That takes time and planning. Second, they actively pulled purchases forward, accelerated deliveries of products, basically getting goods into inventory before the higher tariffs kicked in fully, front-running the changes.
Ah, okay. That makes sense.
And third, they went back to their suppliers, secured some vendor concessions, and importantly, they applied some select, very targeted price increases, but only on really innovative products where they felt the customer loyalty was strongest.
That acceleration, pulling product forward, that must explain the inventory jump we saw on the balance sheet then.
You got it. Inventory was up 13% on a FIFO basis, first in, first out.
Right.
And normally you might see that and worry about sales slowing down.
Right, and thinking product isn't moving.
But in this case, it wasn't necessarily poor sell-through. It was a deliberate tactical move, building a buffer, minimizing the hit from those looming tariff hikes.
And they expect that to normalize.
Yeah, they were pretty clear. They expect inventory levels to decrease kind of naturally through the rest of the year now that that initial acceleration push is mostly done.
Okay, so they implement these strategies, shifting supply chains, accelerating orders, getting concessions, some price hikes. After all that, what's the final net impact they're actually baking into their forecast for the year?
The current annual guidance now reflects a net tariff impact of somewhere between $25 million and $35 million for the full fiscal year 2025.
Okay, so down from a potential $80 million to $35 million.
Exactly. And when you frame it like that, you see why the market cheered. They proved they could manage it, control the controls, essentially cut that huge risk down significantly.
All right, let's pivot now and look at the brands themselves, because underneath all the cost management, the consumer demand picture still seems, well, pretty mixed, right?
Definitely mixed, yeah.
We have to start with the biggest piece, the core brand, Tommy Bahama. How did it perform?
Tommy Bahama, yeah. It's the largest revenue driver, about $229 million in the quarter. But performance was, let's say, not great. Revenue was down 6.6% year over year.
And comps?
Comps were tough. A high single-digit negative comparable sales figure. Management was pretty upfront about it, said performance just didn't meet their internal goals.
Did they say why? What were the issues?
It got pretty specific, actually. They mentioned problems with like color assortment and just line completeness, having the right mix of products in the right places. Particularly, they called out Florida as a weak spot because of this.
Interesting. But not weak everywhere.
Apparently not. Performance was reportedly firmer in the Western U.S., some regional variation there.
But even within Tommy Bahama, wasn't there a specific bright spot, something that showed pricing power is still possible?
Yes, and this is maybe the most important anecdote from the brand discussion, I think. They launched a new pant, the Boré Island Chino.
Okay.
The key thing here, they introduced this new updated style at a higher price point, significantly higher, $158 versus the old version at $138.
Bold move in this environment. How did it do?
Very high sell-throughs. Across their direct-to-consumer channels, it flew off the shelves, essentially.
So the loyal customer will pay up for newness.
It confirms exactly that. The loyal Tommy Bahama customer base will pay for differentiated, innovative, premium products. It really validates their strategy of being disciplined on pricing where the product supports it.
That success story makes Lilly Pulitzer look even better by comparison, maybe. Because that brand seems almost like bulletproof compared to the macro trends.
Lilly Pulitzer continues to be remarkably resilient, just really reliable. Revenue was only down about 1.5% overall, landing at $90.3 million.
Okay, slightly down overall, but the direct channel.
That's the key. They actually posted a low single-digit positive comparable sales figure in their direct-to-consumer channel, which is obviously their most profitable channel.
Positive DTC comps in this environment is pretty strong. What drove that? Just brand loyalty?
It seems to be a mix of loyalty and, importantly, product innovation tied cleverly to their heritage.
How so?
Well, they had good success with new items. They specifically mentioned a linen sea spray jacket doing well. But they also tapped into their history really effectively. They debuted this thing called the Lilly's Vintage Vault Capsule Print.
The throwback collection.
Exactly, a throwback collection that apparently exceeded their initial expectations. It shows they can successfully mine their own print archives to drive demand and, crucially, full-price selling.
Okay, so Tommy Bahama, challenged but with bright spots. Lilly Pulitzer, holding strong. What about the other pieces? Johnny Was and the emerging brands?
Right. Johnny Was, it definitely remains challenged.
Yeah.
Revenue was $45.4 million, but it suffered a low double-digit negative comp. That's still the clear weak link in the portfolio right now.
Any signs of a turnaround there?
Management said they have a comprehensive plan underway. But importantly, it's not focused on, like, opening more stores right now. It's more about internal restructuring, enhancing merchandising, tightening up the marketing, getting smarter about customer segmentation, basically trying to reestablish momentum from the inside out. It's a fix-it job.
Got it. Fix-it mode for Johnny Was. But the emerging brands group sounded like good news.
Excellent news, actually. And it really justifies their whole portfolio strategy, I think.
What's in that group again?
It includes Southern Tide, the Beaufort Bonnet Company, or Beaufort Bonnet Duckhead, and Jack Rogers. That whole group together delivered really solid growth.
How solid?
$38.5 million in revenue, which was up 17.0% year over year.
Wow, 17% growth.
Yeah, so that segment is showing clear momentum. And you can see why that matters, right?
Yeah.
When your two biggest brands are either dealing with softness like Tommy Bahama or need fixing like Johnny Was,
Right.
having that strong bench strength in the emerging brands really proves the strategic value of being diversified.
Yeah.
It provides a nice counterbalance.
Okay, so that covers the results, the mitigation efforts, a mixed brand picture. Let's look forward now. Guidance is always key, especially the outlook for Q3. What are they telling us?
For the upcoming third quarter, Q3 FY25, management guided sales to be between $295 million and $310 million.
Okay. And the profit outlook for Q3?
This is important. They warned of a pretty significant seasonal adjusted loss per share. The range is between -0 over 85 cents and -$1.05 per share.
Oh, loss in Q3. Is that typical?
Q3 is historically their softest quarter, seasonally. But yeah, this loss is also compounded by the continued flow-through of those tariff costs we talked about.
Yeah.
So tough quarter is expected.
So given the Q2 revenue miss we started with, and now this forecast for a loss in Q3, the confidence booster really had to be the full-year reaffirmation, didn't it?
That was absolutely the linchpin, the critical piece that drove that investor reaction. They reaffirmed the full-year guidance.
No changes at all.
No changes. Sales are still expected between $1.475 billion and $1.515 billion for the full year. And adjusted EPS is still forecast in that $2.80 to $3.20 range.
So by sticking to that range, despite all these headwinds?
They're basically signaling, look, the short-term macro noise, we're managing it, our cost structure can handle it, and we still see a path to hitting these full-year numbers. That's a powerful message.
Did we also hear anything encouraging operationally about how Q3 has actually started?
Yes, and this is a really key kind of leading indicator, perhaps. They said comp sales quarter to date, so in the early weeks of Q3, are actually running modestly positive.
Positive comps after Q2's negative.
Yeah, in the low single-digit range positive. That's a significant recovery and a step up from Q2's -5% trend.
What did they attribute that to?
Better assortments finally hitting the shelves seem to be the main thing, and maybe some renewed consumer re-engagement. Hopefully it signals that those specific issues at Tommy Bahama are being addressed effectively.
Fingers crossed. And finally, before we get to our trade idea, any updates on strategic investments? Are they still investing for the future?
They are, which also shows confidence in the longer term. The big project, that new distribution center in Lyons, Georgia, that's proceeding on track. Expected completion late fiscal 25 or maybe early fiscal 26.
That's a big spend, right?
Huge spend. But they anticipate that capital expenditures, CapEx, will moderate significantly once that massive DC project is finished, probably in FY26. So light at the end of the tunnel on spending there.
In store growth.
Still planning for growth, yeah. They mentioned a net increase of about 15 full-price stores across their brands, plus 3 new Marlin Bar openings planned by the end of this fiscal year.
Okay, interesting. Now that brings us nicely to the segment where we explore the, shall we say, more tactical side of things. It's time for This is not financial advice.
Our favorite disclaimer time.
Exactly. This is purely analysis of market dynamics, folks. Always, always consult a qualified financial professional before making any investment decisions based on anything you hear here.
Got it. So we just talked about this massive technical move in the stock, right? Jumping over 20% after being down almost 50% year to date before the earnings.
A huge swing.
What happens when a stock does that? Implied volatility in the options market spikes dramatically. You got extreme pessimism just like flip into extreme relief almost overnight.
Okay, so if volatility is suddenly really high, what kind of outrageous but plausible trade idea does that potentially set up for someone looking at this tactically?
All right, so the trade idea here, playing off that vol spike, is to consider selling puts on OXM, probably with a relatively short-term maturity, maybe targeting the end of the third fiscal quarter around that time frame.
Okay, selling puts. Just quickly for listeners maybe less familiar, what does that mean?
Sure. When you sell a put option, you're essentially taking a bet that the stock won't fall below a specific price that's the strike price before the option expires. You collect a cash payment, called a premium, up front for taking on that risk.
So why this strategy now? It sounds like you're betting against the recent huge rally continuing.
Exactly. It's a bet that this current euphoria, which was driven by just enormous trading volume, like 1.7 million shares traded versus a normal average closer to 470,000.
Wow, big volume spike.
Huge. The bet is that this euphoria peaks quickly and starts to fade. The market has already priced in the success of the tariff mitigation story, but has it fully digested the reality of Q3? The seasonality, the structural challenges, the fact that guidance calls for a significant loss, potentially up to $1.05 per share.
Good question.
So the logic is, as we get closer to that Q3 loss actually being reported, maybe some technical factors kick in. The stock might drift back down a bit, maybe towards the midpoint of that affirmed full-year EPS guidance range.
And if the stock drifts sideways or down slightly, the high implied volatility that's currently priced into those options starts to decay.
Precisely. That volatility decay, or Vega crush, as traders call it, benefits the seller of the option. So you collect that inflated premium up front thanks to the rally's volatility spike, and then you hope the stock kind of stabilizes or drifts lower, allowing that volatility premium to erode before the option expires.
So it's less a bet on the company's fundamentals long term and more a tactical play on the market, maybe overreacting, the volatility spike, and the calendar moving towards a seasonally weak quarter.
You nailed it. It's a tactical bet on technical retraction after a colossal relief-driven move. Exploiting the vol spike, banking on stabilization rather than continued massive upside or a sudden collapse before that short-term option expires.
A compelling, if definitely high risk, a high volatility idea for the tactical trader out there. Okay, let's bring this all back home. Summing up this Oxford Industries call.
Yeah.
The essential takeaways seem to be that critical EPS beat and, maybe even more importantly, the reaffirmed full-year guidance were powerful enough to outweigh the slight revenue miss and the very real margin pressure they faced.
And that confidence, that market reaction, it really seems rooted in two things. First, the proactive and clearly successful tariff mitigation strategy.
Right.
And second, some genuine green shoots showing up in brand health.
Yeah.
Particularly the strength in Lilly Pulitzer and that positive comp trend they reported seeing early in Q3.
So if we zoom out a bit, what's the final thought for listeners tracking OXM going forward?
What's fascinating is that the immediate battle, right, managing costs, managing logistics against that tariff shock, seems like they've largely won that battle for now.
Okay.
But connecting this to the bigger picture, the long-term story for the investor, the company's trajectory still really hinges on its core brand performance. Long-term success still relies entirely on whether Tommy Bahama can sustain that Q3 comp improvement we saw starting.
Makes sense.
And critically, whether they can structurally get those gross margins back up into the mid-60% range as these costly sourcing shifts continue and hopefully normalize into 2026. That's the next chapter.
That structural margin recovery at Tommy Bahama, that will absolutely be the metric to watch going forward. All right, thank you for diving deep with us into the Oxford Industries earnings call today.
My pleasure.
We definitely encourage you to explore the material further if this is in your wheelhouse and keep tracking that Tommy Bahama margin story. We'll talk to you next time on The Deep Dive.